Good morning, viewers. It is very great to be reconnecting with all of you. So Happy New Year to all of you. I'm Binette van Wyk, Chief Operating Officer at Catalyst Fund Managers, and this morning I'm joined by two gentlemen. I'm joined by Mbula Soroto, the Portfolio Manager of our SA long-only listed property portfolios, and then also Norbert Sass, Group CEO of Growthpoint Properties. Welcome, gentlemen.
Thank you.
Norbert, I'm going to start with you. Growthpoint has been a REIT for roughly 10 years, and you converted to a REIT in August 2013, right? What were maybe the key drivers for that decision to convert to a REIT, and what were some of your expectations for going forward?
So look, I think prior to the REIT regime, we were the capital structure of the company was what we used to call linked units, shares linked to debentures, and more and more those hybrid type structures came under scrutiny from SARS, and it became very evident to us that globally listed property had gone the REIT route, and that we as South Africa needed to move forward. We needed to fall in line with international trends and norms, and we needed to come up with a REIT structure which took away this uncertainty around any potential negative tax consequences. But also, we used to spend of an hour meeting with international investors. We used to sit there for 15 minutes talking about how the dividend works, and it's part share, part dividend, and part interest, and it was wasteful time. After we sort of got the REIT regime up and running and we converted to a REIT, it was a 1-minute discussion. We're a REIT, we pass through our income. There are 3 or 4 key sort of criteria to be a REIT, and it was quite simple. And I think it was very important to attract not only additional South African capital, but also international capital. To attract that capital, you needed to have a REIT status, a REIT name, a REIT regime that was clear, simple, and understandable for investors. And I think it actually worked a hell of a well, to be honest with you. I think the capital that flowed into the sector, between 2013 and 2018 or whatever it is, was enormous.
Yeah, I mean, Norbert, you make a good point there, because I reflect back and look at where the sector was trading back in 2013. I think sub 7%. Growthpoint itself, obviously a beneficiary of the flows, but today we find ourselves where the sector is trading double-digit yields, including Growthpoint. I mean, can you maybe talk to the evolution of the sector's performance since? What was the reasons, call it, for the derating, both for the sector and the company?
Sure. So look, I think there were many factors, and if I cast my mind back to 2013, 2014, I think the South African economy was quite resilient. We had inflation bands of 3 to 6, but we were sort of well within that. Obviously, interest rates would have been lower than where they are now. But I think for me, one of the key factors was growth. There was growth in the sector. Growthpoint's distribution growth in 2013, 14, 15 was like 7, 8, 9% per annum. In terms of dividend growth, you were able to do accretive transactions. We had, as you say, a 7% forward yield on the share price. So we're trading at a premium. You could go out and make acquisitions. You could go out and, raise equity and settle. Probably debt was probably a little bit more expensive than that at the time. So I think that was some of the the key drivers and reasons as to why we were at premiums to NAV then versus why we're at discounts now. Was undoubtedly, the interest rate environment, interest rate cycle, but more critical to my mind was the ability to show growth in our underlying profits and distributions and dividends to shareholders.
Maybe just on that, I mean, what were some of the, call it, significant transactions that transformed the business to what it is today?
So yeah, let's, again, thinking back, became a REIT 2013. 2014, I think we ended up doing the AccuCap SciComm transaction. If I just go a little bit before that even, I mean, the Waterfront deal was 2011. We did the offshore gas transaction 2009. But post-REIT, it was more AccuCap and SciComm. We started, just again linking this back to why we're trading where we are now. We as Growthpoint and the Growthpoint board took a view, or started feeling uncomfortable with the trajectory of the SA economy and the lack of growth that we were seeing coming through 2014, 15, 16. We started getting a little bit concerned, and we started strategically looking at, moving offshore, but also moving into what we call the equity light sort of strategy, the funds management business that we quite heavily invested in today. So 2016 we did the first, what I would call strategically deliberate offshore acquisition investment, which was Globalworth. GOZ was 09, but it wasn't, to my mind, strategically deliberate. It was more opportunistic in that it was off the back of the global financial crisis. Share price, the Australian listed property sector had collapsed by 80% from the peak in 07 to the trough in 09, and it just presented an amazing opportunity. So it was much more opportunistic. South Africa, we lagged the world with regards to the global financial crisis. The world sort of entered that period, 08, 09. We had the euphoria of the 2010 World Cup. Our economy was still relatively, interest rates, we still had access to debt capital, whereas, in Australia, the guys didn't have any access to debt. So, but more deliberate was the Globalworth offshore investment in 2016. 2017 we started funds management. We did the healthcare fund 2017. 2018 we expanded in the funds management business with the formation of Lango. We invested additional capital into Globalworth at the time. And then December 2019 was capital in regional.
Yeah.
And look, sadly, 3 months after that, COVID hit us squarely between the eyes, and it's been a pretty uphill battle since then. In fact, to be honest with you, if you talk about the performance again today and compared to 2013, 15, COVID has had actually a massive impact on the business, and you've had very structural challenges to the sector. Structural in many forms. One is online retail. Two is more recently with COVID, office and work from home. Talk about structural challenges to the South African economy with load shedding and these sorts of things. There's just been wave after wave after wave of challenges that's been thrown at the listed property sector, and then more recently now, obviously, in interest rates.
Well, but you've touched on quite a bit there, but just for the moment, let's park on the growth, and I specifically want to focus on how real estate companies can unlock value. And now we all know there are many ways to do it, but one that we've seen in the SA listed property sector, which has recently surged, is mergers and acquisitions, or just as everyone calls it, M&A. Now, often a REIT that trades at a discount is often the target of these M&A transactions. Now, given that we all know that the South African listed property sector has been trading at a discount to net asset value, or NAV, once again, as we call it, I just want to ask Mvula, are you and the team supportive of these M&A transactions that has been happening quite often recently? And do you foresee, if we look at the near future, do you see some more happening?
Look, I think it's an important question, that given where we find ourselves as a sector. Maybe first on your first question, I think being supportive of the transaction, you need to look at the merits of the transaction firstly. I don't think M&A in itself should just be a supported, call it catalyst for unlocking value. There have been transactions in the past that have destroyed values for shareholder. But I think what's key for us is looking at the value unlock and the merits of that transaction. I think where the sector is currently, where some of these listed counters are trading, illiquidity has become a problem for some of our shareholders. So I think where there are small caps that are probably trading in the same space, where we think there could potentially be synergies to be unlocked, it does make sense to some degree. Obviously, trading at a discount, some of the investors or the buyer can access these attractive assets at a discount to where it's trading in the private markets. So that's a cheap way of accessing the real estate. I think of recent, we've seen a lot of companies actually being opportunistic in the acquisitions. Like you mentioned earlier, Norbert, I mean, you looked at Capital Regional, I think just before Brexit and COVID. And I mean, obviously there you were seeing an opportunity to access retail that was obviously attractively priced where the company was trading versus going and buying those assets directly in the market. And obviously, given that a lot of companies are trading at discounts, there are those opportunities that we think could still unlock and play out into this new financial year. So maybe just quickly on Capital and Regional, where are you currently positioned? How are you viewing that company potentially going forward? And maybe some of your other offshore equity investments. I mean, is there opportunity to unlock value there?
So, yeah, look, I mean, just to maybe answer both of your questions and try and do it in one go. I mean, I personally do believe that, you know, there is scope for, you know, M&A in this type of environment where, you know, everybody's trading at a discount, some trading a slightly bigger discount to the next one. But the critical thing is, I think, as you pointed out, you know, some of the smaller stocks become so small that they're almost uninvestable for some of the big, more, you know, institutional type investors because of the lack of liquidity. So in the UK, I think just in the last 3 months, I think there've been 2 or 3 sort of M&A acquisition or M&A opportunities announced in the real estate space in particular. I think you'll see the same dynamic play out, you know, in some of the other markets, certainly also the ones that we're playing in Eastern Europe and in Australia. I think, Nomvula, just coming, if you know, to touch on the 3 different regions that we're in, you know, certainly our view on Australia remains very positive, you know, in terms of the overall economic fundamentals and dynamics and also property specific dynamics. So, you know, you have low unemployment, you've got, you know, economic growth, interest rates will come down. We are, let's call it, I wouldn't say overweight, but we're heavily exposed to obviously the office sector. There's a sense which, and a sentiment which is, to my mind, coming out of the US mainly, is that, you know, the office sector is dire and that, you know, it's sort of uninvestable. We don't see that as being a global, let's say, trend or dynamic. I think it's very specific to specific countries, but even more specifically to certain cities within certain countries. So you go to downtown Sydney, you go to downtown Melbourne, I mean, people are coming back to the office and, you know, flexibility in terms of working arrangements is here to stay. But if you've got a growing economy that is, you know, that you need to create office space for companies who are expanding and growing, you'll definitely, you know, get the vacancies down and eventually the demand will come back. So that's sort of Aussie. Eastern Europe, we've seen exactly the same thing play out. Initially, some of the big multinationals, global multinationals who were using those regions as sort of outsource regions, BPO, you know, sort of business process outsourcing destination. I was initially a little bit worried that Poland and Romania would have lost some of that appeal, but I think we've already seen a change in that whilst, you know, some of the big 4 or 5 have given back space, there's an emergence of a new sort of client base who are coming to those regions to get into that space. So I think it's a matter of time. Those markets will come back. And in the UK, I mean, the UK economy is struggling at the moment. I think Brexit is still sort of playing out. Retail in particular is still sort of challenged, if you want. But again, the Capital and Regional sort of focus is, you know, more the affordable retail. It's the, as Lawrence Hutchings, the CEO, they would call it, you know, sort of needs-based retail as opposed to wants-based. And operationally, things are very solid. I mean, the actual letting, in those assets, you know, is good. And so, you know, it's a cycle, and I think, you know, it's going to take a while. There's no doubt, I think CapReg is sort of subscale, you know, market cap of just sort of over £100 million. pounds is not, it doesn't really hit the radar screens. So I think we strategically we got to find solutions, but exactly what those are, we don't quite have all of those figured out.
Okay, maybe just to circle back, on some of the, call it, benefits of converting to a REIT. You mentioned earlier attracting offshore investors. You mentioned simplified balance sheets, and obviously the struggle back then was an understanding of the old structure. But looking at where Growthpoint is today, recently excluded from the MSCI, we've talked about offshore investments venturing there and some of the, call it, instruments or funding tools that you used to actually acquire these assets. Would you say, again, looking back 2013, that the company has simplified its balance sheet? And given that, there's potential prospects of offshore investors reducing given the exclusion from MSCI, is that now a risk to the investment case for Growthpoint?
No, I don't think so. I think the exclusion from MSCI, from my understanding, is pretty much just the market cap based and index driven. So I don't think there's anything that talks to the fundamental business case of what Growthpoint is today, and the balance sheet and the various funding structures that we have. No doubt, I think our balance sheet is probably more complex today than it was in 2013 once we've added the international dimensions. But also when adding, let's call it, the fund management dimension. So I think the fund management is still relatively new. And whilst we believe it is very scalable in the domestic market, it is taking us much longer to, let's say, get access to big chunks of South African pension fund money. It's taking longer for us to get access to them. I think there are a couple of things to my mind that are playing out here. One is, we've had a change in Reg 28 from 30% to 45%. So many of the trustees are, sitting on the, at trustee meetings at these pension funds, and they're being sold the story that they need to go more offshore. So when we come with a domestic product, which we think has got legs and merit, we're finding that there's sort of a resistance, if you want, because right now you've got this offshore bias. So I think that again, I don't believe there's any reason for us falling out of that index other than pure sort of indexation, traditional indexation dynamics, which is about sort of market cap and that.
Viewers, I know we're talking SA listed property, but I think it is key to just highlight to all of you that if you look at the SA listed property sector on a see-through level, that roughly 50% of that is actually offshore, hence all the emphasis on offshore today. But we know offshore has its own set of problems. As Norbert alluded to, we're still facing some of the blows from COVID-19. There's ongoing geopolitical risks, higher inflation, higher interest rates, hence now people facing a cost of living crisis. But I believe there are pockets of opportunity. So Mvula, where do you and your SA team, where do you see those pockets of opportunity within the SA listed property sector, but looking offshore?
Yeah, I think maybe looking at the universe, we have a handful of opportunities outside of South Africa. The one Norbert has been touching on, CE, including Romania and Poland, where some of our listed names are actually operating. We've got Nappy Rock Castle there, which has been one of our top picks for some time now. Still currently trading at a discount to NAV and attractively priced in terms of its earnings growth potential. So in terms of region or geographic exposure, we still like that region for statements that Norbert has made now. I think it's defensively positioned. The economy is still growing. We've seen actually wage growth that's far surpassed inflation and obviously has supported retail sales growth there. It was one of the first regions to actually recover post-COVID. So obviously their sales are well above pre-COVID levels, and that's actually helped the tenant affordability. So we've seen some strong revergence coming through in some of the reported numbers from Nappy and MES. Unfortunately, MES last year was an underperformer, but we still like that company. And obviously relative to the UK, where we think there's still potential risk of a mild recession or soft landing there. I think the consumer could potentially still be under pressure given the high interest rates. But there is promise in terms of interest rate cuts in the back end of the year, which potentially could translate into increased disposable income to obviously support the retail sales in that region. Obviously, Australia, we've got an indirect investment there with Growthpoint, but we still see some risks there facing the economy, especially on the office front relative to some of the other subsectors. So, I mean, geographically, I think that's where we positioned. In terms of subsectors, I mean, again, it's a handful of subsectors in terms of the three traditional commercial real estate subsectors, but the one we like is definitely retail. We've seen a strong recovery in retail sales, at least locally, from obviously the lows of COVID. So there's been a strong recovery there, and we're still positioned well there. Obviously, in the defensively positioned companies in terms of their balance sheets and the like. Offices locally, we think will potentially still be a challenge. And vacancies have improved, but they're still high, obviously, relative to the long-term historical averages. So given that and given the limited rental growth, we think potentially a laggard relative to the other three. Industrial is an interesting one. I think the subsector is one that we like. We think the demand-supply dynamics are actually balanced, so that we don't see any upside risk or downside risk to that subsector. But when you look at the company specifics, there are some nuances on a company level that actually has led us to being underweight the subsector. So on a company level, we see, I mean, some companies actually poorly positioned in terms of their LTVs, and then given Fortress recently with the corporate action, it's been a moving target there. So we are currently underweight that, call it subsector.
Thanks, Mbula. So let's actually focus back on, I want to focus back on local and the broader sector, and let's have a look at what happened in 2022 and 2023. So I know the sector hasn't been like the darling for most allocators recently.
It's been kind.
2022, within the SA asset classes, it was the worst performer. Then we had last year when it was the best performer, and gents, you will both know that most of those returns were made up in the last month of 2023. In December, we made up, most of the returns were actually made in December with 9.9%. But now let's look forward. Obviously, holding thumbs that 2024 will be a good year, and looking ahead. But the numbers are a bit concerning, I guess. If I've recently looked at the Alexander Forbes Large Manager Watch survey, and there, if you look at balanced funds and you look at multi-asset funds and you look at their allocations to the SA listed property sector, it doesn't look that great. It's sitting at roughly, well, it was sitting at roughly 3% on average for last year, but the peak was actually in 2017, where it sat at 6%. Now, we all know the market and the SA listed property sector has had a bit of a love-hate relationship, if you guys think that analogy is right. So I would love to hear your thoughts in closing on the outlook for the SA listed property sector. And I think, Norbert, let's start with you.
So, to my mind, by far and away, the biggest impact or driver of the performance is going to be, again, interest rates. What are interest rates? Have they peaked? And I think there's a general feeling that they have peaked, but the question really is, okay, how quickly do they start coming down again? And then how far do they go? So some of my personal perspectives on this is I do think, it's peaked. I think it's going to come down. But I don't think we're going to get back down to interest rates where they were prior to this sort of sign. Maybe they come halfway down to where they were. I think if you think of maybe a 20 or 30-year cycle of where interest rates have been and where they've peaked and where they've, where they've been at the bottom. We was at the bottom for an artificial low, if you want, to my mind, for a very long time. And I think we've gone up, but we'll come back down again, but not all the way down. So the big question is, all right, well, how quickly do we come down, and then how far is it? Now that's going to have an impact not only in terms of, let's call it the actual cap rates and discount rates and let's call it your risk-free rates and those kind of dynamics, but also on the income statement in terms of, how much interest are we paying. And I think my personal, I guess, hope is that we start getting interest rate savings. It starts pushing earnings higher. We start getting out of. We currently obviously we put out negative earnings outlook. Hopefully we can arrest that and get back into positive territory. Not obviously 24, but maybe into 25. But we do need some help from the overall economy. I think at the end of the day, in the absence of reasonable economic growth, this 1% kind of number just doesn't cut it. It's not enough to stimulate demand. There's always, on the upside, there's very little supply coming through, but there is still supply coming through. Developers never stop developing, so you are still seeing some supply. You need, with 1% growth, you need zero supply, to sort of clear the oversupply that currently exists. So, but I also feel that operationally we've had all these challenges with COVID and otherwise, or let's say load shedding and otherwise. It's almost like that's in the base now. It's still there. We're still going to have it. I mean, the question is, are we going to have another 330 days of impact from load shedding? But sort of in the base, we know how to deal with it now much better than we did. So, feeling a bit more positive generally about where the sector is and where the company is, and so yeah, I think I'll leave it there.
Yeah, and I think for the sector, quite similar to Growthpoint, and I think it's important to differentiate between the, call it SA-focused companies versus your offshore names, because I think a lot of the growth that we are seeing is actually offshore. And I mean, you mentioned earlier on offshore currently making up on a see-through north of 50% of the benchmark. So that is quite important when you talk about the outlook for the SA-listed property sector. I mean, maybe starting on the SA-focused names, I mean, Growthpoint has alluded to negative earnings growth guidance for 24. We've got a few other names that we still think will continue to underperform. But a lot of that is actually in the base. I mean, Norbert mentioned that. I mean, I think the main driver for that negative earnings have been interest rates that are in the base in 23. If you look at the outlook for 24, there are some interest rate cuts that are projected. So, I mean, for a junior end like Growthpoint, we don't think that will translate into these earnings. But, I mean, looking forward into 25, we could actually have a nice recovery from this low base. So offshore is definitely giving the sector some growth. I mean, your Napi Rock castles have got strong growth fundamentals coming into 24, at least from our own projections. And we think that will continue to drive the sector's earnings going forward. So overall, we think the sector will do muted growth given the balances of the negative on the SA-centric and then the strong growth from the offshore. But looking forward to 25, we start seeing some nice recovery potentially on the back of interest rate cuts. I mean, again, if you look at where we are trading now, discount still to NAV despite the recovery that you mentioned back end of last year. So we sit around 30% discounts to NAV, and we think a lot of the negative news is currently priced in, and it's quite attractive, I think, to be entering with the always earnings guidance of 25 as well.
Thanks, Mbula. Viewers, I think it is very important to note what has already been priced in, but I do get a strong sense of cautious optimism from the two gentlemen. So we're very excited to see what 2024 has in store for all of us. Thank you so much, Norbert, for your time and for making yourself available for this informative discussion. Mbula, as always, thank you for your insights. Viewers, thank you for tuning in. If you'd like to learn more about our H2 SA dashboard, please refer to the report, or alternatively, please reach out to me as per the contact details below. Thank you and goodbye.